So you think you're doing pretty well. You've got a nice car in the driveway. A 3-year-old SUV with leather seats and a navigation system that you're still paying for. You've got a house. 4 bedrooms, 2.5 baths, a backyard for the kids, a 2-car garage that barely fits both cars. And last summer, you bought a boat. A nice one. A 22-foot bowrider that you financed over 10 years because, hey, it's only $300 a month. You look at your life and you think, I've made it. I've got assets. I've got stuff. I'm building wealth. You update your net worth calculation. You add up the value of your house, your car, your boat, your furniture, your electronics. You look at the number and you smile. $500,000. Not bad for someone who started with nothing. Then you go to the bank. You want to refinance your mortgage, or take out a loan for something, or maybe just talk about retirement. And the banker asks you a simple question. What are your assets? You tell them, house, car, boat, the works. And they say, okay, but what are your income-producing assets? And you're like, what? I just told you, the house, the car, the boat. And they look at you like you've just spoken a different language. Here's the thing, you have been speaking a different language. You've been speaking the language of stuff. And the bank, the tax code, and everyone who actually understands money? They've been speaking a different language entirely. That house you're so proud of? It costs you $30,000 a year in mortgage, taxes, insurance, and maintenance. That car? It costs you $10,000 a year in payments, insurance, gas, and repairs. That boat? It costs you $5,000 a year to store, maintain, and insure something you use 3 times a year. And when you count them as assets on your net worth statement, you're doing what millions of people do. You're lying to yourself. Not intentionally, but you're lying, and that lie is costing you everything. Hi, what's up? And I spend way too much time thinking about the difference between assets and liabilities. Like, probably an unhealthy amount. I've watched too many people get excited about their net worth, only to realize that their net worth is actually a net drain. If you're someone who's ever counted your car or your house as a source of wealth, only to wonder why you still feel broke, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because what I'm about to tell you might make you uncomfortable. It might make you question some of the biggest financial decisions you've ever made. But I promise you, by the end of this video, you're going to see your finances completely differently. Now, before we dive in, I want to make something clear. Most people think investing is about having a lot of money. The truth? It's about what you keep. I'm building a community at the Frugal Investor newsletter where we strip away the hype and focus on high-impact, low-cost wealth building. Get your copy of the 15-day blueprint for wealth and financial autonomy and join a group of like-minded investors who prioritize long-term gains over short-term trends. Link is in the description. Alright, let's get into it. The definition problem. Let's start with a simple question. What is an asset? If you ask 100 people that question, 99 of them will give you the same answer. An asset is something you own that has value. Your house, your car, your boat, your jewelry, your collection of vintage guitars. And technically, they're not wrong. Those things do have value. You could sell them. You could get cash for them. By that definition, they are assets. But here's the problem. That definition is missing something. Something crucial. Something that changes everything. Robert Kiyosaki, the guy who wrote Rich Dad Poor Dad, had a different definition. He said an asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. Now, that definition might sound simple. It might even sound like semantics. But it's not. It's the difference between being wealthy and looking wealthy. It's the difference between building freedom and building a prison. Let's apply that definition to your house. Under the first definition, your house is an asset. It's worth something. You could sell it. Under Kiyosaki's definition, your house is a liability. It takes money out of your pocket every single month. Mortgage, taxes, insurance, maintenance, utilities. It's a hole that you throw money into. Even when it's paid off, it still takes money. Taxes, insurance, maintenance. It never stops taking money. Now, you might be thinking, my house is appreciating. It's going up in value. That makes it an asset. And you're right, houses do appreciate. Historically, about 3 to 4% a year. That's real. That's value. But here's the thing. You can't eat appreciation. You can't pay your bills with appreciation. You can't retire on appreciation unless you sell the house. And if you sell the house, you have to live somewhere else. So you're either buying another house, which will also cost you money, or you're renting, which costs you money. The point is, your house is costing you money every single month. And until it starts paying you, it's not an asset. It's a liability that might be going up in value. The car catastrophe now. Let's talk about cars. Because cars are even worse. Your car is worth something. Maybe $20,000, if it's a few years old. Under the first definition, that's an asset. You own it. It has value. Under Kiyosaki's definition, your car is a massive liability. It costs you money every single month. If you have a payment, that's money. If you own it outright, it's still costing you. Insurance, gas, maintenance, registration, depreciation. And here's the thing about depreciation. It's not just a loss of value. It's a transfer of wealth. You're paying money to own something that is losing value every single day. The moment you drive a new car off the lot, it loses 20% of its value. 20%. That's $10,000 on a $50,000 car. Gone. In an instant. Now, you might be thinking, but I need a car. I can't just not have transportation. And you're right. You need transportation. But you don't need a $50,000 car. You don't need a $60,000 truck. You don't need a $70,000 SUV. You need a reliable way to get from point A to point B, and that can be a $10,000 used Honda Civic. That's not an asset either. It's still a liability. It still costs you money. But it costs you a lot less. And that difference? That difference is wealth. The boat blunder. Let's talk about the boat. Because boats are a special kind of financial disaster. You bought a boat because you wanted to enjoy life. You wanted to take your kids out on the water. You wanted to fish with your buddies. You wanted to feel the sun on your face and the wind in your hair. And there's nothing wrong with that. But let's look at the numbers. You bought a 22-foot bowrider. It cost you $40,000. You financed it over 10 years. $350 a month. Not terrible, you think. But then there's the slip. Another $200 a month. Insurance. Another $80. Winter storage. Another $100, averaged over the year. Maintenance. Another $50. Fuel. Another $100, if you actually use it. Add it up. That's almost $900 a month. $10,800 a year. For a boat you use maybe 10 times a year. That's $1,000 per trip. For a boat that's losing value every year. A boat that, in 10 years, will be worth maybe $10,000 if you're lucky. Now, is that worth it? Maybe. If you love boating, if it brings you joy, if it's your thing, maybe it's worth it. But don't call it an asset. Don't count it on your net worth statement and pretend you're building wealth. It's not wealth. It's an expense. A big, expensive, ongoing expense that you're choosing to have. And that's fine, as long as you know what it is. As long as you're not lying to yourself. The psychology of pretend wealth. This is where it gets really interesting. Why do we do this? Why do we count our cars and our boats and our houses as assets when they're clearly costing us money? It's because of something called status signaling. And it's one of the most powerful forces in human psychology. When you see someone driving a nice car, what do you think? You think they're successful. You think they have money. You think they've made it. And because we know that other people think that, we buy nice cars. Not because we need them, but because we want other people to think we're successful. The same goes for houses. The same goes for boats. The same goes for watches and clothes and all the other things we buy to signal our status. But here's the problem. When you buy things to signal status, you're not building wealth. You're spending wealth. You're trading your future freedom for the approval of people who don't care about you. And when you count those things as assets, you're not just spending wealth. You're lying to yourself about it. You're telling yourself that the boat is an asset, that the car is an asset, that the house is an asset. And because you believe it, you feel wealthy. You feel like you've made it. And that feeling? It keeps you from actually building real wealth. Because real wealth is boring. Real wealth is money in the bank. Real wealth is investments that pay you. Real wealth is the freedom to do what you want, when you want, without worrying about money. And that doesn't come from buying things. It comes from owning things that pay you. The real definition of wealth. So let's redefine what we're talking about. Let's use the definition that actually matters. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. Now, let's look at your stuff through that lens. Your house takes money out. Liability. Your car takes money out. Liability. Your boat takes money out. Liability. Your furniture takes money out and loses value. Liability. Your electronics takes money out and loses value fast. Liability. Your clothes takes money out and loses value instantly. Liability. Now, what actually puts money in your pocket? Rental properties put money in. Assets. Dividend stocks put money in. Assets. Bonds put money in. Assets. Businesses put money in. Assets. Your savings account puts money in. Asset. See the difference? It's not about what you own. It's about what your money does. If your money is working for you, putting money in your pocket, that's an asset. If you're working for your money, putting it into things that take it away, that's a liability. Now, here's what most people don't realize. You can turn liabilities into assets. You can make your house put money in your pocket. How? Rent out a room, rent out the basement, turn it into a duplex. Suddenly, it's not taking money out. It's putting money in. You can make your car put money in your pocket. How? Use it for Uber. Use it for DoorDash. Rent it out on Turo. Suddenly, it's not a cost. It's a tool that makes you money. You can even make your boat put money in your pocket. How? Rent it out. Charter it. Use it for fishing tours. Suddenly, it's not a hole you throw money into. It's a business that pays you. The point is, it's not about what you own. It's about what you do with what you own. And that's where most people get it wrong. They buy things and call them assets. But they never ask the question that actually matters. Is this thing paying me, or am I paying for it? The Millionaire Next Door. There's a famous book called The Millionaire Next Door. And in it, the authors studied actual millionaires. Not the ones on Instagram with rented cars and borrowed watches. Real millionaires. People with real wealth. And here's what they found. Most millionaires don't look like millionaires. They drive used cars. They live in modest houses. They don't buy boats. They don't wear expensive clothes. They don't signal status. Why? Because they understand the difference between assets and liabilities. They know that buying a status symbol isn't building wealth. It's spending wealth. And they'd rather have the wealth than the status. The millionaire next door drives a 10-year-old Toyota. The millionaire next door lives in a house that's smaller than they can afford. The millionaire next door has money in the bank, money in investments, money that works for them. And the guy with the new BMW and the big house and the boat? He's probably broke. He's probably one paycheck away from disaster. He's probably living a lie. He's not wealthy. He just looks wealthy. Now, which one do you want to be? The one who looks wealthy but is broke? Or the one who looks normal but is actually free? Let me tell you about two people. Let's call them Dave and Sarah. Dave is the guy everyone thinks is successful. He drives a brand new Mercedes. He lives in a big house in the nice part of town. He has a boat, a motorcycle, a whole garage full of toys. He's always posting pictures on Instagram of his vacations, his dinners out, his lifestyle. But here's what people don't see. Dave's car payment is $1,000 a month. His mortgage is $3,500. His boat payment is $500. His credit card bills are another $1,000. He's making $150,000 a year, but he's spending $180,000. He's going further into debt every single month. Sarah is the one everyone thinks is boring. She drives a 10-year-old Honda. She lives in a small apartment. She doesn't have any toys. She doesn't post pictures of her life because there's nothing flashy to post. But here's what people don't see. Sarah's rent is $1,200 a month. Her car is paid off. She has no debt. She's investing $2,000 a month. She has $300,000 in her retirement accounts. She's on track to retire at 55. Now, who's wealthier? Dave, with his fancy car and his big house and his boat? Or Sarah, with her boring life and her growing investments? Dave looks wealthy. Sarah is wealthy. And that's the difference. The action plan. Alright, so how do you stop lying to yourself? How do you start building real wealth instead of just looking like you have it? Here's the action plan. Step 1. Redefine your net worth. Stop counting your car. Stop counting your boat. Stop counting your furniture. If you want to count your house, that's fine, but be honest about it. Count it at what it would actually sell for today, minus what you owe. And understand that even if it's worth something, it's still costing you money. Your real net worth is your investments. Your cash. Your real estate that actually pays you. Everything else is just stuff. And stuff is not wealth. Step 2. Audit your stuff. Go through everything you own. For each thing, ask yourself one question. Is this thing paying me, or am I paying for it? If it's paying you, keep it. If you're paying for it, Ask yourself if you really need it. If you don't need it, sell it. If you do need it, find a cheaper version. A reliable used car instead of a new luxury SUV. A modest house instead of a status symbol. Step 3. Turn liabilities into assets for the things you keep. Ask yourself if there's a way to make them pay you. Can you rent out a room in your house? Can you use your car for rideshare? Can you rent out your boat when you're not using it? If you can turn a liability into an asset, you're not just stopping the bleeding. You're actually building wealth. Step 4. Redirect the savings. Every dollar you save from selling things or downgrading your lifestyle needs to go somewhere. Not to more stuff. To investments. To things that actually pay you. Set up automatic transfers. Invest the difference. Let compound interest do its work. Step 5. Stop caring what people think. This is the hardest one. Because a lot of this is about status. It's about wanting people to think you're successful. It's about wanting to keep up with your friends and your neighbors and your family. But here's the truth. Those people aren't paying your bills. They're not building your retirement. They're not going to take care of you when you're old. So why are you spending your money to impress them? Stop caring what people think. Start caring about your future. Your future self will thank you. # the asset test. I want to give you a simple test. A way to tell if something is really an asset or just a liability pretending to be one. The test is this. If you lost your job tomorrow, would this thing help you or hurt you? If you lost your job, would your house help you? No. It would hurt you. You'd still have to pay the mortgage. You'd still have to pay the taxes. You'd still have to pay for maintenance. It would be a burden. If you lost your job, would your car help you? No. It would hurt you. You'd still have to pay the loan. You'd still have to pay insurance. It would be a burden. If you lost your job, would your boat help you? No. It would be a huge burden. Now, if you lost your job, would your rental property help you? Yes. It would still generate income. It would help you survive. Would your dividend stocks help you? Yes. They would still pay you. They would help you survive. Would your savings account help you? Yes. It would give you time to find a new job. That's the test. That's the difference between an asset and a liability. An asset helps you when things go wrong. A liability makes things worse. # the freedom number. I want to end with a concept I call the freedom number. Your freedom number is the amount of income your assets generate every month. Not your salary. Not your side hustle. Your assets. The things that pay you while you sleep. For some people, the freedom number is $2,000 a month. Enough to cover their basic expenses. At that point, they're not dependent on a job anymore. They could quit. They could take a lower paying job they actually enjoy. They have options. For some people, the freedom number is $5,000 a month. Enough to live comfortably without working at all. At that point, they're not just free. They're retired. They're done. For some people, the freedom number is $10,000 a month. Enough to live luxuriously without working. At that point, they're not just wealthy. They're rich. Now, here's the question. How do you get to your freedom number? Not by buying things that cost you money. By buying things that make you money. By turning your money into assets. By letting your assets pay you. That's the path. It's not glamorous. It's not flashy. It's not going to impress your neighbors. But it works. It's the only thing that works. And it starts with understanding the difference between assets and liabilities. I really hope this video brought you some value today. If it did, comment more down below. I'm reading through those to decide what topics to cover next, so definitely let me know if you want more of this. Look, here's the bottom line. That car in your driveway? It's not an asset. It's a liability. That boat in the marina? Not an asset. Liability. That house you're so proud of? Unless it's paying you, it's a liability too. And that's okay. You can have liabilities. You can have things that cost you money. But don't lie to yourself about what they are. Don't count them as assets and pretend you're building wealth. Because that lie is the most expensive lie there is. The real path to wealth isn't about buying things. It's about owning things that pay you. It's about building assets that generate income. It's about reaching a point where your money works harder than you do. And the first step on that path is seeing clearly. Seeing that your car is a cost, not an asset. That your boat is an expense, not an investment. That your house is a liability, not a retirement plan. When you see clearly, you can make different choices. You can sell the things that are costing you and buy things that pay you. You can stop trying to look wealthy and start actually being wealthy. And that's what this is about. Not looking rich, being free, being able to walk away, being able to say no, Being able to choose the life you want to live. That's real wealth. And it starts with knowing the difference between an asset and a liability. Alright, I'll see you in the next one.